Hi everyone! Wall Street ended last week with moderate gains. All three benchmark indices were able to bounce from their lows, snapping a three-week losing streak. Thus, they closed the week in the black. Optimism is likely to persist this week as market sentiment remains bullish. Nevertheless, the sentiment will largely depend on fresh macro stats. For instance, traders are waiting for the release of the US Consumer Price Index with bated breath. This report could provide clues about the Fed's future steps on monetary policy. Apart from that, the US is going to unveil retail sales data and the University of Michigan Consumer Sentiment Index. Wall Street investors will be closely monitoring fresh figures, as this is the last batch of economic reports before the FOMC meeting next week. The Fed is expected to raise the key rate by 75 basis points for the third time in a row and is still dealing with the runaway inflation. Watch our video review till the end and find out more news on the stock market. Feel free to leave your comments down below. Let's start. Last week, the economic calendar was almost empty. Several Fed policymakers delivered speeches talking about the need to stick to aggressive tightening. The US stock indices regained momentum on Friday thanks to a rise in tech and other shares. Besides, the two-year US Treasury bond yields, which are sensitive to comments of interest rates, reached a 14-year high. Analysts assume that market sentiment improved as investors had to come to terms with a 75 basis point rate hike in September after 3 weeks of uncertainty. According to the futures, the likelihood of such a rate hike totals 87%. Speculators have realized that other scenarios are impossible now. Inflation keeps soaring. For this reason, the central bank has to tighten monetary policy aggressively in order to rein in inflation. Christopher Wallace said on Friday that the regulators should be aggressive with the rate hikes while the economy can take a punch. A day earlier, Jerome Powell confirmed that the Fed's top priority is to curb galloping inflation. Meanwhile, the yield curve has inverted even more. Investors tend to consider inversion as a sign that a recession in the US may occur in the next year or two. Last Friday, the Dow Jones climbed by 1.1%, the S&P 500 index rose by 1.5%, and the NASDAQ jumped by more than 2%. Last week, the Dow advanced by 2.6%. Investors are revising their portfolios as consumer prices are expected to decline again. The Consumer Price Index in August is projected to slow down to 8.1% from July's 8.5%. If the reading unexpectedly grows, it could stir up demand for safe haven assets, exerting pressure on stocks. However, there are also positive fundamental factors that could help stocks maintain a bullish bias for some time. The US economy has demonstrated resilience at a time when other large economies are on the verge of a recession. On Monday, Wall Street tried to extend Friday's rally, and bulls hope that CPI data will reveal that inflation has finally peaked. A drop in gasoline prices is likely to lead to a decrease in the CPI index by 0.1% in monthly terms, according to Reuters. Excluding gasoline, core CPI is expected to rise by 0.3%, the same as July. Hence, even if the indicator edge is low, it's likely to be a moderate decline. In addition, analysts warn investors not to pin great hopes on this report. In October and months ahead, there could be another spike. This is why volatility on Wall Street is likely to persist. Investors may react to CPI data differently. However, a weaker than expected reading could rekindle hope for a 50 basis point increase in September. As for S&P 500 index, it approached the pivot level, signaling the probability of a further rise. Many think tanks, including UBS, predict that the S&P will grow about 4,200 in 2023. In the near future, its upward potential is quite limited. At the end of last week, the S&P managed to rebound to 3.6%. However, given the high volatility in the stock market, it would be unwise to count on long-term steady rise. This is why it's better to be bracing for new swings. The Fed is widely expected to raise interest rates by at least 100 basis points by the end of this year. There could be even more aggressive increase if inflation does not slow down as analysts have anticipated. As cash rates will remain high for a long time, the baseline scenario for Wall Street implies further volatility, lower corporate profits, and higher than expected default figures over the next year. Judging by technical indicators, the future trajectory seems rather clear. A bullish gap may occur amid a certain combination of events and factors. So far, bulls have successfully defended a potential support level of 3,900. If the index consolidates above this level, it will be able to test 4,115, 4,160. After that, the index may touch 4,200. Alternatively, the S&P 500 index settles below 3,900, a bullish scenario will be cancelled. The price may approach the previous bullish gap on 3,790. Shortly after, it could slide to the June low of 3,630. The resistance levels are located at 4,063 and then at 4,120. The heavy tech NASDAQ, which has been dropping for a while due to monetary tightening, was also able to rebound last week. The index notched the best results, rising by 4.1%. The new week is going to be quite eventful, yet a further rally on Wall Street is quite questionable. The Fed will hardly change its stance even if inflation slows down. Fed policymakers have made this clear. A rally on stock markets looks like an upward correction, partly triggered by oversold conditions after Powell's speech at Jackson Hole. Stocks have already climbed considerably, so there is almost no upward potential for a short-term recovery. Apart from the CPI report, traders are also anticipating the quadruple witching hour. It happens on the third Friday of every calendar month when three types of securities expire. On top of that, there should be several treasury auctions which could affect the movements of bond yields and stocks. This event could have an even greater impact on stocks than the publication of inflation data. Investors will also digest the earnings reports of Oracle and Adobe. The Twitter drama is still not over. Shares of the social media company dropped on Monday by almost 2% to $41.37. The company's stock is currently trading at $37.45 per share, well below Musk's offer price of $54.20. The conflict between the parties continues. On Monday, Twitter's lawyers said that billionaire's attempt to walk away is invalid and wrongful, a day before the company's shareholders are vote on the $44 billion deal. Twitter and Elon Musk will face off in the Delaware Chancery Court on October 17. That's all for now. Subscribe to our channel and keep close tabs on market developments. See you.